It's a great pleasure to be here at the Jersey Finance event, which is always one of the highlights of the year in terms of these sectors. The mandate for this panel is to contemplate global trends across the whole of the alternative funds spectrum, or, I quote, an in-depth look at developments in real estate, private equity, hedge, debt and infrastructure, including the role of international flows on the fund's areas. So in other words, everywhere and everything in 30 minutes in depth. The reduced Shakespeare company, eat your heart out. But fortunately, I am blessed with four panelists who are masters of both the seminal and the succinct. So we have a fighting chance of at least scraping the surface of what's a rather ambitious overall agenda. I'll just ask them to introduce themselves for 30 seconds or so, saying who they are and what they do, to place some sort of context for you, starting with Paul.
Hello everyone, my name is Paul Rouse. I'm the CFO of Systematica Investments. I think that I'm asked to be on this panel to give a real world view of what it's like to be in the hedge fund industry in Jersey at the moment, and to give my thoughts on where we're going with some of these transparency, operating model, cost pressures that we're going to talk about for the rest of this panel.
Just so.
Thanks, Tim. I'm Ben Robbins. My day job is partner in Morinto Zan's law firm in Jersey, where I do predominantly real estate and private equity investment fund work. And by night, I'm chairman of the Jersey Funds Association. So have a bit of a feel for, I guess, the types of business that we're seeing in the island at the moment.
Mike Jones, Director of Policy at the Jersey Financial Services Commission. I guess my role is to give you the regulatory perspective on the trends.
And finally, Michael.
Mike Gray. I'm an advisor to a number of private offices, but here in the capacity as a non-executive director of a private equity group, and also involved in infrastructure deals as well.
Splendid. Well, look, should we start with, if you like, the known knowns before going on to the known unknowns or the unknown unknowns that people are facing? So there are certain key developments in the sort of global funds landscape with which we are familiar. Those of rising costs, those of ever-increasing regulatory pressures from multiple sources, and a seemingly relentless drive, if sometimes a little unfocused, for greater transparency. How are these trends impacting the alternative funds class, and which do you feel over the medium term is actually the most meaningful and challenging of them? Starting with, in this case, Mike.
We've heard a lot about it already, but I think that the big one from a regulatory perspective is clearly still AIFMD, which, as all regulators and politicians know, stands for All Investment Funds Must Die. We're a third country in Jersey based geographically within the EU. Now that could be a situation familiar to the UK before long, but it means that market access to Europe is obviously absolutely paramount for Jersey. So we've clearly, as a regulator in a jurisdiction, done lots of work in response to AIFMD, so engaging with ESMA, engaging with other regulators, and so far, touch wood, that's paid off. Obviously we had the ESMA announcement last summer in terms of one of 3 jurisdictions to be granted a passport, or no obstacles to the granting of a passport. I was checking my phone in the break, and I actually had an email from ESMA. It didn't say when the passport is to be granted. You'll be disappointed to hear, but it just shows you that the dialogue is continual actually between the regulators, ESMA and the European Commission. They're continuing their assessment of additional jurisdictions, and we're likely, or so they say, to hear the results of that in the summer, or possibly Q3 more likely. So that's still for us the big regulatory trend.
Just as a quick follow-up on that, I mean, looking beyond the passport itself to the sort of promised land of AIFMD II, which sounds like a kind of lousy movie, sort of sequels are invariably worse than the original. But do you sense in this case that the political atmospherics around the industry may have eased a bit since those of 2010-11. You've got Commissioner Hill there, that actually this might end up being, at least in part, a relatively sensible exercise in trying to scale back some of those features of the original AIFMD that have proven to be most awkward for external investors?
I think so. I mean, we were at the European Commission around about Christmas time, speaking to sort of Gerson and Sven Gedner and his team about, don't forget you've got AIFMD II that is scheduled to start not too far away from now. And they're at pains to say, no, it's just to start. We don't have to actually do anything. We've just got to start the work. So I think you're right. I think it may well be tidying up rather than new regulation.
Excellent. Paul, which of this sort of cast of horrors is the one that looms largest over you?
So you won't be surprised to hear that I come about this from a financial perspective and more the costs. So to give you some background, to put in context where my thoughts are, Systematica inhabits the quant side of the hedge fund business. So inherently, the biggest issue for us is probably not increasing costs, but rather fees, and particularly management fees, being squeezed and the margins they're getting lower. So that means for us the key is scalability, is efficiency. We're very fortunate that we have a decade of experience before we spun out at the beginning of this year, and unlike other hedge fund managers that may be here, these haven't changed us over the last year. We've launched with these pressures, and so we've had to have a very close look at these. We think that technology is key. We think that people can't ignore that, and we think that information is key. So we've heard a lot about transparency so far this afternoon. I come at it from a slightly different angle, rather than just the regulatory transparency, but also our investors. What's been very clear to us in year one of operation is that investors don't only ask for transparency these days, it's an absolute prerequisite. And one thing later, our CEO, who sadly can't be here today because she's traveling, she often says that with the exception of our quant models, the intellectual property there, our life is an open book. And often now, I would say that investment decisions are made not just by fund returns, but almost more importantly by the level of DDQ and transparency that we are able to give. And so we can't just pay lip service to that. We've actually been through a process this year of rewriting a lot of our prospectuses. We've been providing access to senior management. We've been rewriting policies. We've in fact completely restructured our fee structure for a lot of our funds and made them a lot more straightforward. So that's very key. In terms of regulatory costs, I have been surprised actually this year, a lot of the setup that we've had to do, some of the costs involved in that. What we've often found is that by their very nature, a lot of regulatory reporting is inherently sort of lumpy. And because we run a very lean organisation, we've got $10 billion of assets under management, only 100 people. We can't afford to have big teams that can absorb the sort of regulatory costs on a quarterly or 6-monthly annual basis. And so we have to partner with our advisors, our administrator, legal advisors in order to be able to take that on. So I think in terms of operating model for the future, I think that sort of outsourced but keeping the knowledge in-house is going to be key in the future.
And just to follow up there, you talked about the sort of the fee squeeze. Does the fee squeeze make it inevitable that there will be some sort of shrinkage of the industry, either in terms of the number of funds or the number of people, headcounts that are inside those funds, or do you think it's possible for the whole of the industry to adapt to this new world sufficiently quickly that it can sort of collectively go on the sort of crash diets necessary in order to be there and survive?
It's interesting, particularly, I think one area where fee costs, and this is an area that doesn't affect us so much, is around the discretionary traders and the costs in that world, whereas we don't have that. You know, the cost as such is not so much the problem, but with the fee squeeze, inevitably there will be some smaller players that are pushed out of business and the barriers to entry. But I do think that in this new world of big data, to use a cliche, and technology, I just think that if people from day one can use that technology and their partners and the wider service industry around hedge funds effectively, I think that everyone should be able to manage in that world.
Switching to Michael, from your perspective, are the challenges that we've set out here, are they essentially an irritation, a cost, compliance burden, etc., or do they represent something which is more of a sort of fundamental threat to the business model?
I don't think it's a fundamental threat, but it's more of an irritation. I think if we look at the two elements, the cost element and the regulatory element, I think the cost side, I think there are some interesting things that we can do to reduce the cost. As a fund director and responsible to the investors, I think that's very important. I think in Jersey, in particular, most people won't be aware of the close cooperation between Digital Jersey, but there are some really innovative people on the technology side that are working in an alignment with the finance industry and with the regulator to actually make some of those efficiencies a real thing in Jersey, if you like. And one of the big areas is KYC AML from the point of view of onboarding investors and so on. So there's some great work going on in that area to try and reduce costs, reduce the sort of regulatory burden through use of technology, basically. On the regulatory side, I think we're still seeing the march on of more regulation. Looking forward to even the 7th of March, just a few days away, we've got the senior manager regime in the banking side that's going to focus the minds of banks to a much greater extent, perhaps, than hitherto, from the point of view that there will be some real consequences if the risks that each of these officers of the company are responsible for are not actually dealt with in a sensible way. That might have a knock-on effect as to the appetite that banks have to lend. I mean, we know there's been a shortage of capital, something like 350 billion euros of capital that's had to be collected to make up for the financial crisis, if you like. There's still a shortage of about 20 billion in the banking industry in the sort of top 100 banks. So you'll see more descaling of the banks, the reduction in the size of the banks, and that provides an opportunity for some of the debt funds and so on to fill that gap. And as Bill was saying, some of the pension funds as well to come in and actually take some of the longer term assets off and finance that a bit better. So regulation itself is helpful for the security of investors and so on. There are elements of irritation, but it's for us to sort of work through those and hopefully make a benefit out of them.
Right, excellent. And despite the challenges we've mentioned, the past couple of years have been pretty good in terms of overall private equity fundraising.
Yep.
Pretty resilient.
Yep.
With interest rates apparently sort of set to stay low or even go negative for longer than perhaps we would have thought if we were having this conference a year ago, and the conventional equity market looking at a fairly volatile place. Are you reasonably confident that investors will be knocking on doors and looking to invest in the private equity sector as robustly over the next 2 years as there have been over the past?
Yeah, I think so. I think you've seen it already with some sovereign wealth funds, etc., taking money away from asset managers, from equities, if you like, from the more liquid elements, where they've seen that as being more volatile, and they've favoured the less volatile, illiquid private equity assets. So I think you're going to see that. I think you've seen that in 2015, and from some of the discussions that I've heard from investors, I think they're keen to bolster that in 2016 and onwards.
Okay. And finally, Ben.
Well, I think the regulatory challenge, I would split it into sort of 3 levels. Level 1 is what's international and inevitable, and I think Pascal was talking about that earlier. I mean, that is tax and the information sharing agenda and anti-money laundering, which Jeff alluded to earlier. I think Jersey's position is very much to be at the head of the international pack to make sure that we confront these challenges, recognise them, as industry, absorb them as quickly as we possibly can, because they're inevitable and they impact on every fund domicile. And I think we've done a great job thus far in absorbing and coping, whether it's with FATCA, CRS to come very shortly, and BEPS we touched on earlier. And I would agree with Justin. I think because of our substance proposition, I think we're well placed to deal with that. So that's unavoidable. It's global. You have to deal with it. Then there's the international stuff, which has varying degrees of impact. And AIFMD is a very good example of that. So we're at the moment a privately placing jurisdiction. There's 200 or so funds in Jersey that are already marketing in this way into Europe. It's working well. It's not easy in every European country, but actually when you look at the status quo, it's not too different to where we were 5 years ago. And then there's the issue of full compliance if we do get the passport. And I think Simon was alluding to it earlier. In some cases, we look at the different asset classes for private equity. Asset stripping has been an issue. Remuneration is an issue. Real estate, the external valuer is becoming a difficulty for that industry. And in hedge funds, I think the constraints on leverage and remuneration are creating difficulties. Right now, those aren't impacting on managers operating in Jersey. And Jeff alluded to the proposition earlier of being either in when the passport comes, or privately placing and tailoring the extent to which that regulation will apply to you. And right now I think we're in a good position. And I think the final tranche is how you organise yourself locally as a fund domicile. We have our flexible regimes, very private placement expert, and looking at the statistics for the last couple of years across all of those different types of regulatory products, there's good growth.
Excellent.
So I think right now we're coping pretty well.
And just to follow up there, you mentioned by allusion and the OECD process, which BEPS is part, and so is interest deductibility, and we know there are 15 different work streams out there. What aspect of that process should be concerning the people in this room the most, or should they just take a relatively relaxed view that this is a sort of high-class talking shop in the end?
It won't be a high-class talking shop. I mean, I think it was alluded to earlier. I think there are two issues of key that we need to really take notice of. One was the debate we discussed this morning about the continued access to treaty benefits, and one would hope that because the tax neutrality of funds ultimately is an uncontroversial thing, some kind of resolution will be found. And I think Justin alluded to it earlier, we're already having to burrow into who our investors are through the anti-money laundering process, and when we onboard investors, so actually finding out whether they have individual treaty benefits should not be too difficult. So I'm sure there will be a positive outcome there. And then the other element is just this concept of asset managers being taxed where the activity is taking place, and that is about substance. And there will be challenges for jurisdictions which host management activity, or at least say they host management activity, that simply doesn't happen there. And whether it's what Mike is doing with the Triton team, or what Paul's doing at Systematica, what you're seeing in Jersey is substance being laid down by managers. So I would hope it's an area to be aware of, cognizant of. We have to watch how those key areas develop, but right now it's not creating fear. I think it may create opportunity, or hopefully at worst status quo.
Okay, well let's change tack a little bit. There is an absolutely raging debate about whether assets under management in South America, Asia, Africa, and the Middle East are set to grow much faster than the developed world and thus become more attractive, or whether to some degree the experience of Brazil over the past 4 or 5 years is a kind of a canary down the mine shaft, and in fact there may be quite a shift in sentiment back towards the developed economies, even if they're not growing as fast, but because they're perceived as a sort of safer harbour. Where do you think you stand in that particular argument, perhaps this time around starting with Ben?
Well, I think the first thing to say is don't ignore the core, the sort of UK and European core, because I think that has been hugely strong for us in the last year or two. Lots of the activity that Bill alluded to earlier, we've seen in Jersey. Yes, London has been, London commercial property investment has been very, very buoyant in the last year. We recognise, I think exactly what Bill was describing, the move into other cities, but the broadening of the types of real property that's being invested in. And in private equity, we've seen real buoyancy around European private equity in Jersey. I think in terms of activity we're seeing in emerging markets, it's very spotty. There are Turkish funds which we're still seeing at the moment. There are, rather than I think funds being established in Jersey for wide investment in Africa, we're seeing project by project infrastructure type investment being routed through Jersey at the moment. So it's happening, but I think the core has been of most importance to us. An interesting area of development I think has been US PERE activity. US managers have woken up to Jersey's ability to host structures which can be used for global real estate. We're working on one at the moment which will hold an element of US and an element of European real estate. So that for us has been a very interesting development, moving into that US market, which hitherto has been not closed to us, but has been quieter.
Michael, are you an emerging markets man, or do you prefer your markets to be emerged already?
No, I think there's going to be a balance. I think I am still wary of certain markets. The legal framework and so on, quite obviously, is not as strong as in the Western developed world, if you like. So there are still issues there. But I think that there's kind of two elements to it. I think it's the support level from the point of view of investment coming in, as well as the actual assets. So I think there's still demand there, despite what I said earlier about sovereign wealth funds taking money out of some of the more liquid assets. They are definitely putting in a support level into that, and the banking disintermediation as well. There's a huge amount of funding required in if you want to say conventional or Western assets, there's a hole there of something like €1 trillion that still needs to be filled. So although there's a lot of unused capital at the moment, it's a case of that will probably get filled first before people take the step into some of these other markets. But I think if you look at more adjacent countries or developments, if you look at Australia and Asia, the energy side is big on there, and infrastructure projects. I think Macquarie has launched another fund just recently, another $3 billion into that area. So I think there'll be quite a lot of money going to infrastructure in sort of Australia and Asia, less so in Africa, although the demand for agricultural land and feeding ourselves as a global entity going forward is going to mean that Africa will benefit from that sort of investment. And I think you're seeing sovereign wealth funds and others investing heavily in those areas, relatively speaking. But I think there's still a bit of a wariness over some of those markets, as opposed to the still great opportunities that there are in the West, if you like.
So, Paul, from a hedge fund perspective, I mean, is there exciting, fertile, virgin territory out there, or is being this far away from Mayfair quite enough as far as you're concerned?
So we're very much into the emerged, I think, side of the argument. We have a head office, obviously, in Jersey with our oversight of the risk function, but we do have salespeople across the world. Our biggest market is North America. Probably 44% of our investors are from that market, followed closely by 29% the EU and the UK. Interestingly, possibly in third place, 23% of our investors are in the Middle East. And to the question of have we seen any softening of that market with the oil price fluctuations and uncertainty in the Middle East? No, not to now. And we've got a lot of active conversations going on in the Middle East. I think it's offset to some extent by sovereign wealth funds and the need to diversify. But something that's already been mentioned actually by Mike, probably our smallest market to date is Australia and Asia, with only 4%. And in fact, the reason that Leda was not able to be here today is because she's travelling to Japan, and that's a big growth area for us. I think that in terms of South America and Africa, I did speak before this event to our head of sales, who's based actually in New York, and we are seeing those areas beginning to sort of internationally invest, but the alternatives market is fairly far down their food chain. We often see the long only followed by the private equity, and maybe in a few years for us, but Asia for us is probably the biggest growth area.
Okay, and Mike.
I mean, it's not a regulator's job to grow markets or sort of say that this is where you should and shouldn't do business. We often do get asked our views on particular jurisdictions, and the answer is always quite simple from our perspective. There's no good or bad jurisdictions. There's good and bad business, and there's good and bad people, and you've got to do the appropriate due diligence on those people, and perhaps there may be inherently riskier jurisdictions or industries, and you may want to ask more questions in that respect. I guess the regulator's job is to make sure there are no barriers there, and things like the market access in terms of AIFMD, international engagement, where Jersey sits on bodies like IOSCO, engages with other regulators to make sure there are no bilateral issues, signs MOUs. We just signed an MOU with the Abu Dhabi General Market last week. I think we've got 90-odd bilateral MOUs now, so that's probably more our role.
Right. Admirably diplomatic, so one would expect from the regulator. A sort of 30-second answer on this one, then I'll throw this open to the audience. Jersey's traditional strength has been in the real estate asset class. Will that be as true in the future as it has been in the past? Ben? 30 seconds.
Still very important. Private equity has always been important, and its geographical reach for Jersey is getting larger all the time. Hedge funds, though, and the inward migration of hedge fund managers to Jersey is a very, very interesting and exciting trend. So we'll be both a domicile, but also a service providing and management jurisdiction for hedge funds, and that's why Paul's here.
Excellent.
I sort of answered the question just by sitting here, but I will elucidate a bit further. But certainly our experience has been very good. We first started speaking to the JFSC when we spun out of our parent company back in September 14. And we've been very impressed both with Jersey Finance and the JFSC as to how professional and commercially minded they've been with us. From a personal point of view, trying to build a finance team out in Jersey, I've been very impressed by the pool of talent and the breadth of knowledge there. That's been very useful. And then from a personal point of view, maybe this isn't the reason why hedge funds are moving in, but as some of you have seen on my biography, my original degree was marine biology, so moving to an island near France in the hedge fund world, my wife thinks it's all part of my plan for the last decade. So,
excellent. Michael, very swiftly.
I think there's still going to be a lot of money coming into the sort of real estate side. I think it's going to be interesting to see what happens. There's fresh money perhaps going to come in from Iran as some of the entities there have released equity and what have you, and see what happens there. But I think the real estate side will continue to be very positive. But I think infrastructure, the keynote speaker, nailed it very nicely. The demand and requirement that there is there. So I think that will go in. That will move forward quite a bit. And I think the people that we've got on Jersey who actually understand the infrastructure, real estate, and debt markets, that should actually help as well as part of that decision making on the island and the governance related to that.
Do we have any questions, comments, observations, abuse? Doesn't seem to do Donald Trump any harm. From the floor? If not, then I will throw the loaded grenade, that is the Brexit question, at the panel. I won't ask you to predict the result, but let's just say, what do you think the consequences are one way or the other, depending on how the result comes out? Who'd like to touch the live grenade first?
I'll take it in the sense that I won't be very controversial. A few people have said it is a democratic decision. For someone like Systematica, we have very little impact in the EU. Our only EU office of the 5 we've got, an entity, is in the UK at the moment, right. And that's a service office. Suffice to say, stability is usually better for business, but otherwise we're not so bothered. On a personal view, just to throw maybe a second smaller grenade out there that might be interesting is I'm interested to see how the Scottish National argument comes into this, in that the Scottish National people would like to stay in, and I'd be interested to see if what happens if the rest of the UK votes out, but we're kept in by virtue of a strong in vote from Scotland. That'll be interesting to see how that pans out.
The jock factor, always worth it. Ben, I mean, what difference will it make to you and to Jersey?
Yeah, I mean, that's a good question. I mean, putting the UK to one side, and clearly we don't have any say in it, so it will be done and we will react accordingly. On the one hand, you might think, well, surely no change. You're a third country for all sorts of European purposes, closely allied to the City of London, and certainly that latter point will never change. I think our destinies are very closely entwined with the City of London. I think it would be very difficult, even if there were to be a Brexit. My personal view is I think it would, on balance, be better for us to remain in. And that's my personal view. If there were to be some kind of exit, I think the work that's already been done to build the connections between Jersey and Europe, we have our own Channel Island Brussels office. Jeff alluded to the work that's already been done to demonstrate Jersey's value to Europe, to demonstrate to Europe that there is already huge value coming to Europe from Jersey. The work that Mike and his team have been doing in building bridges with ESMA and the European regulators, there's still very strong infrastructure there, so one would hope whichever way it goes. Maybe we'll be a little bit of a sort of island of stability while there's an element of uncertainty around the UK and Europe.
And Michael, how does this register on your personal risk register?
I think it is a big issue, actually, because I think initially the uncertainty, has been said by many others, is very unsettling for business. And there'll be a bit of paralysis, I suspect, in some decision making for a period of time. But I think what's already been said about Europe being very important and its link with Jersey is great, and the additional work that's been done to reinforce that and grow it is increasingly important. But I think, as far as London and as far as the UK is concerned, and wealth creation through London, if they're out, then that could be impacted very, very severely, and that has a knock-on effect. Just not necessarily within the UK. It has some impact for Jersey as well, with the close alignment between UK, London, and Jersey.
And Mike, finally, as a regulator, would your workload suddenly become 80% easier if none of these European directives were relevant to the UK, or as relevant as they are today?
Unfortunately, I think it's a bit more complicated than that, and not necessarily would be the answer. And I think the sort of official Jersey position is the status quo, i.e. remain is the preferred position. I think from my personal perspective, if we come out, nobody really knows for sure whether life will be better or worse. I suspect it'll be neither. It'll be different. But if one of the options is there's going to be lots of work, there's going to be lots of uncertainty, there could be a loss of confidence, I think I'd favour the other option.
Splendid. Well, I think we've covered an enormous amount of ground in a relatively short period of time. So on your behalf, could I thank our panellists very much indeed. Thank you, gentlemen.